So over the past couple of weeks, we've obviously been witnessing some significant economic developments, and it has sparked widespread concern. What I want to do in this video is delve into the recent market turmoil that's been triggered by the latest round of tariffs imposed by President Trump. And I want to draw comparisons to past economic downturns. And then I want to outline actionable steps for you that you can start taking in order to safeguard your household finances during these uncertain times. So let's go ahead and dive in. Back on April 2nd, as you know, President Trump announced a comprehensive set of tariffs, and it included a 10% baseline on all imports and additional levies targeting specific countries, most notably 145% tariff on Chinese imports. And this move, referred to as Liberation Day, aimed to address trade imbalances, but instead it actually ignited immense volatility in global markets. And the market's reaction was swift. You've probably felt that. It was severe. On April 3rd, the S&P plummeted by 6.65%, and that marked the most significant single-day drop since the COVID-19 pandemic-induced crash back in 2020. The Dow Jones Industrial, that actually fell as well by 3.98%, and the NASDAQ declined by 5.8%. And the following day, which was April 4th, we then saw continued declines. The S&P lost an additional 5.97%, and that brought the two-day loss to approximately 10%. The Dow dropped another 5.5%, and the NASDAQ fell by 5.8 additional percentage points, officially entering bear market territory at that point. Now let's go ahead and shift our focus to how this market disruption has affected other major investment categories, most notably cryptocurrencies like Bitcoin, and what this means for long-term investors, especially those with retirement accounts such as 401ks or IRAs. Perhaps that's you. Despite Bitcoin often being labeled a hedge against inflation or market instability, we've repeatedly seen that during these sharp global risk events, especially those that hit investor confidence, crypto assets can behave more like risk-on assets, and this sell-off is a reminder that crypto is still volatile. So let's talk about retirement accounts, because I think that's where this is really going to be hitting home for tens of millions of Americans. If you have a 401k or a traditional Roth IRA, you likely have broad exposure to mutual funds or ETFs or even target date retirement funds. And many of these are heavily invested in the S&P 500, the Dow, and the NASDAQ, and which, as we've discussed, those have experienced drops of 10 to 15% in just days. So here's what that means in real terms. If you had, say, $250,000 in your 401k and it was invested primarily in US equity funds, a 12% drop would wipe out $30,000 virtually overnight. Even target date funds, which are typically more conservative the closer you are to retirement, those still saw losses ranging from between 4% to 9%, depending on their allocation to stocks versus bonds. And some retirement plans now include a small percentage of crypto. And that volatility only adds another layer of risk, as we mentioned. And this is why fear is natural, everybody. This is completely natural to be scared, to be panicking, but it's not always productive. Remember, we've seen this before, and that's what I want to review now. In March of 2020, retirement accounts lost 30% of their value in less than a month. But by the end of the year, the market not only recovered, it actually hit new highs. So if you had sold during the panic, you'd have locked in those losses. But those that actually stayed calm and stayed their course, they were rewarded. Some actually saw double-digit returns in the months that followed. So if you're staring at your retirement balance and you're sort of starting to feel that panic rise up in you, here's what I'm going to urge you to do. Don't sell out of fear, okay? Market dips, especially fast ones, they will often correct just as quickly. So selling now often just means that you're going to be buying it back later at a higher price. Number two is I want you to keep contributing. All right. And that can be tough to do. I mean, if you're actively employed, your retirement contributions during market dips are actually buying these assets on sale, potentially one of the best moves that you can make. And this is why we've always encouraged implementing a plan to stay very disciplined and to dollar cost average. Now, just to remind you, dollar cost averaging is basically an investment strategy where you're going to invest a fixed amount of money at regular intervals, and it's going to be regardless of the asset's price, right? Then I want you to go ahead and rebalance if needed. But don't overcorrect. If you're close to retirement, consult with a fiduciary. Make sure to ensure your portfolio matches your time horizon as well as your personal risk tolerance levels. Fourth, I think it's important to avoid checking your account daily. And that might sound simple, but constantly checking is going to lead to this sort of emotional decision-making process, and emotional investing is usually going to be bad investing. History doesn't repeat itself exactly, but it often will rhyme, okay? And we've been through global financial meltdowns. We've been through a pandemic. We've been through a big recession. There have been flash crashes, and yet markets have not only survived, they've grown. And the best investors are not going to be the ones who try to time the market. They're the ones who spend time in the market with discipline, with perspective, and with a steady hand, okay? Now, understandably, these rapid market declines, they can evoke all of this fear and all of this uncertainty. And the bottom line is, it's going to be crucial to recognize that markets have faced and rebounded from significant downturns in the past. I want to actually examine some historical precedents for this. In 2008, the financial crisis back then, the S&P actually declined by over 50% from its peak. Despite the severity, the market began a recovery in March of 2009, and it returned to pre-crisis levels by 2013. And that illustrates this recovery period of approximately 4 years. In 2020, the crash of the pandemic, in February and March of 2020, the S&P fell by about 34% due to pandemic-induced uncertainties. And remarkably, the market rebounded to its previous highs by August of 2020, marking one of the fastest recoveries in history. And these examples, I think, just sort of underscore the resilience of the financial markets over time. So what can we learn from these historical events? I'm somebody that's significantly down, 6 figures down since the start of the year. So these are the takeaways that I'm certainly leaning into. Number one, avoid panic selling. Avoid reacting impulsively to these market downturns by liquidating investments that can lock in those losses and prevent participation in subsequent recoveries. Staying invested will allow you to benefit when the markets do rebound. Number two, I think it's really important to diversify your portfolio. Obviously, most of us will recommend that. A well-diversified portfolio can certainly mitigate risks during the turbulent times, and sort of spreading investments across various asset classes, it can cushion against sector-specific downturns. Third, I think it's important to maintain long-term perspective. Short-term market movements can be unsettling. Focusing on long-term financial goals, however, they can really help navigate volatility and do so effectively. And while the current situation, it obviously has unique elements, the pattern of initial shock followed by gradual recovery is familiar to us. So patience and informed decision-making are really going to be your best friends during times like this. Now, beyond investment strategies, there are going to be some concrete steps that households really should be taking to strengthen their financial positions during economic downturns. Number one, we talk about this, but make sure you have liquidity, make sure you have funds for an emergency. Almost universally, financial experts are now recommending having an emergency fund that'll cover 12 months of essential expenses. This can buffer and provide you some peace of mind during this time, and it'll offer financial stability in case of job losses or unexpected expenses and so on. I think you also are going to really need to reduce discretionary spending. We've talked a lot about this on this channel. You've got to evaluate your monthly expenses. You've got to identify areas where you can cut back and limit non-essential spending so that you can free up resources for yourself to bolster savings, to pay off debts, and of course, to even take advantage of price reductions on new assets. And then avoid new debts. Anytime there's uncertain times, it's prudent to refrain from taking on any new debt. So focus on managing existing obligations, avoid any large purchases, especially anything that would require financing right now. And next, I think it's really important to review and then make adjustments to your budget. You've got to regularly assess your financial situation. You've got to adjust your budget to reflect your current realities. And this proactive approach is going to help you ensure that you remain in control of your finances moving forward. It might help to seek professional financial advice. You can consult with a financial advisor. You can sign up for a free coaching session here by using the link in the description. But they might be able to provide you a personalized strategy in order to tailor your specific circumstances to the future you want to have and help you navigate, uncertain times economically. So history has taught us that economies are resilient, all right? So by staying informed, maintaining a long-term perspective, and implementing prudent financial practices, you can navigate these challenges effectively. But that's nowhere near the end of the impact of these tariffs or this video.